To hit $2,800 a month in dividends, you need to invest around $1.5 million in the S&P 500. Sounds impossible, right? But what if I told you that with just $10 a day, you could achieve the same goal in a fraction of the time? In this video, I'll show you how to reach the $2,800 a month income using just $10 a day, the fastest way possible. I will show a tailor-made portfolio specifically designed for this strategy, which will reach that goal 3 times faster than the broader market. In the end, I'll show you a side-by-side comparison of the S&P 500 and the tailored portfolio, explaining why this approach works best for this strategy. Can the S&P 500 help you achieve $2,800 a month in dividends? Dividends are a powerful way to build passive income. They're regular payments from companies to shareholders simply for owning their stock. Unlike other income sources, dividends are predictable and can grow as companies increase their payouts. But here's the thing, while dividends are a proven path to passive income, not all strategies are equally effective. Many people default to the S&P 500 when they think about long-term investing. After all, it's one of the most popular and trusted indices, representing 500 of the largest companies in the US. Historically, it has delivered an average annual return of 8 to 10%, making it a reliable option for steady growth. However, not all of that return comes from dividends. In fact, only 2 to 3% of the S&P 500's annual returns are typically derived from dividends, with the rest coming from share price appreciation. This low yield presents a major challenge for anyone looking to quickly generate meaningful dividend income. To put this into perspective, let's say your goal is to earn $2,800 per month, or $33,600 per year, in dividend income using the S&P 500. With an average dividend yield of 2.5%, you would need a portfolio worth approximately $1.34 million. And honestly, not many of us would need $2,800 per month if we had that amount of money in the first place. Now, let's assume you're starting with no initial investment and contributing $10 a day, or $3,600 a year. Even with consistent contributions, dividend reinvestments, and the S&P 500's historical average growth rates, it would take about 60 years to grow your portfolio to the size needed to generate that $2,800 level of income. 60 years, a lifetime for most of us, is hardly practical for anyone who dreams of achieving financial independence sooner. So what's the alternative? The solution lies in building a carefully selected portfolio of higher-yield, faster-growing dividend stocks. With the right combination of companies, you can significantly shorten the timeline to reach your income goals. The key lies in focusing on a portfolio of higher-yield, faster-growing dividend stocks. By strategically selecting companies with strong growth potential and reliable payouts, you can accelerate your path to $2,800 per month in dividend income. The math of $2,800 a month. Let's break down the numbers behind the $2,800 monthly dividend income goal. At first glance, it might seem like a daunting figure, but understanding the math can help you see how achievable it really is with the right strategy. To begin, $2,800 per month translates to $33,600 per year in dividend income. The amount of money you need to generate this income depends on the dividend yield of your portfolio. Dividend yield is a measure of how much a company pays out in dividends relative to its stock price, expressed as a percentage. For example, a stock with a 4% dividend yield pays $4 annually for every $100 invested. Here's how the math plays out. If your portfolio has an average dividend yield of 3%, you'd need approximately $1.12 million to generate $33,600 annually. At a 4% yield, the required portfolio size drops to $840,000. With a 5% yield, you'd only need $672,000. Clearly, higher yields allow you to reach your income goal with a smaller total investment. But these often come with trade-offs in terms of growth potential or risk. Balancing yield and growth is critical for creating a portfolio that delivers reliable income while still growing in value. Now let's consider the impact of reinvesting dividends. Reinvestment is the process of using your dividends to buy additional shares of stock. This compounding effect accelerates your portfolio's growth over time, especially when paired with consistent contributions. A reinvested dividend doesn't just grow your portfolio, it also increases your future dividend income because you own more shares that pay out dividends. This snowball effect becomes more noticeable with time as your portfolio builds upon itself, multiplying its value year after year. The beauty of dividend investing is that time works in your favor. The longer you stay consistent, the faster your portfolio grows. But to make it work, you need the right dividend stocks. I'll show you how a tailored dividend portfolio can optimize this process, reducing the amount of time and capital needed to reach $2,800 per month. In the end, I will show you how this portfolio will get you the fastest track to $2,800 per month. In fact, it will reach that target in less than 20 years. When it comes to choosing the right dividend stocks, you've got to think strategically. After all, the goal isn't just to earn dividends, but to build a portfolio that can reach the goal fastest. To reach the financial goal of $2,800 a month in passive income, I focus on a few key selection criteria for building my portfolio. First, dividend yield is crucial. While a higher yield means more immediate income, I avoid extreme yields as they can be risky. Companies with unsustainably high dividends might cut payouts if their financial situation deteriorates. I aim for a yield between 2% and 5% to strike a balance between stable income and growth. Next, I consider the dividend growth rate, or CAGR, which tells me how much a company increases its dividend payouts over time. A strong growth rate, ideally around 10%, indicates that the company is committed to rewarding investors. This growth helps compound my income over the long term. The payout ratio is another important factor. A payout ratio under 60% suggests that the company is in a good position to reinvest in its business while still maintaining dividends. High payout ratios can be acceptable if the company is in a stable industry with predictable cash flows, but I'll prioritize companies that leave room for reinvestment and stability. Diversification is key to reducing risk and improving returns. To achieve this, I'll include real estate investment trusts, or REITs, in my portfolio, as they are required by law to distribute at least 90% of their income as dividends. This makes them a great choice for generating passive income. Lastly, I'll prioritize companies that have a strong track record of both dividend growth and price appreciation. This ensures that my portfolio not only generates consistent income, but also appreciates in value over time. Now that I have covered how I choose the right dividend stocks, it's time to construct a portfolio specifically tailored to help you achieve $2,800 per month in dividends. The goal is to create a balanced mix of high yield, high growth, and stable dividend stocks that will steadily compound over time. This portfolio is carefully designed with 5 selected stocks, each playing a unique role in delivering consistent income and robust growth. At its core, the portfolio includes Rexford Industrial Realty Incorporated, or REXR, a dependable real estate investment trust with a 4.17% yield and a solid dividend growth rate of 11.10%. Specializing in industrial properties, Rexford benefits from the rising demand for logistics and warehouse spaces, offering reliable and predictable cash flows. Alongside Rexford, another key player is CubeSmart, or Cube. This REIT focuses on self-storage solutions, combining a high yield of 4.3% with an impressive dividend growth rate of 14.65%. Adding global exposure is American Tower Group, or AMT, which stands out with a yield of 3.13% and a remarkable 17.48% dividend growth rate. American Tower focuses on telecom infrastructure, a rapidly expanding sector fueled by the global demand for connectivity. Its steady price appreciation and rapid dividend increases make it a compounding powerhouse, driving significant value over time. For added stability, the portfolio includes Kroger Company. As a dominant player in the grocery sector, Kroger offers a stable yield of 2.16% and a 13.63% dividend growth rate. Its position in consumer staples ensures predictable revenue and dependable payouts, even during economic downturns. Kroger balances the portfolio by providing steady income with moderate growth. Finally, there's Lennar Core Class A, or LIN, which focuses on explosive long-term appreciation. While its yield is modest at 1.22%, Lennar's exceptional dividend growth rate of 26.11% and average annual price growth of 13.83% make it a vital driver of portfolio growth. Its ability to rapidly expand both its share price and payouts positions it as a critical component of this strategy. When combined, these stocks offer an average dividend yield of 3%, a dividend growth rate of 16.59%, and an annual share price appreciation of 8.9%. This balance ensures that the portfolio not only generates consistent income, but also grows in value, compounding your contributions and reinvestments over time. Let's take a closer look at how this portfolio grows. In the first year, your $10 a day contribution will total about $3,600 by the end of the year. By year 5, the portfolio grows to about $23,000. Fast forward to year 10, and the portfolio expands to $68,000, generating $3,300 annually, or about $275 per month. By year 15, the portfolio's value reaches $170,000, with annual dividends at $12,000, equating to about $1,000 per month. The real breakthrough comes in year 19, when the portfolio hits $360,000 and annual dividends grow to $34,000, hitting the $2,800 a month target. The key takeaway is clear. This portfolio is built to maximize income while minimizing risk. By focusing on reinvestment, strategic stock selection, and consistent contributions, you can achieve $2,800 a month in dividends within 19 years. Beyond that, the income continues to grow, providing a comfortable margin for long-term financial freedom. Now take a closer look at how it compares to traditional strategies like investing in the S&P 500 and why this method can get you to $2,800 per month much faster. Realistic timeline to hit $2,800 a month. Achieving your income goals through dividend investing is all about strategy and timing. Our portfolio accelerates reaching $2,800 a month in dividends, outperforming traditional methods like the S&P 500. While the S&P 500 offers steady 8 to 10% returns with a 2.5% dividend yield, requiring a $1.34 million portfolio and 60 years with $10 daily contributions to generate $33,600 annually, our customized approach makes a significant difference. With a 3% yield, 16.59% dividend growth, and 8.9% annual appreciation, you can reach $2,800 a month in just 19 years. This dramatic reduction in time is due to a combination of higher initial yields, rapid dividend growth from stocks like American Tower Corp and Lennar Corp, and consistent reinvestment. These factors create a compounding effect that accelerates growth exponentially over time. Compared to the S&P 500, this strategy achieves financial independence 3 times faster. Want to know how to turn a $10,000 investment into a $1 million portfolio that pays over $100,000 in annual dividends? Click the video on screen.